Hey guys, welcome to another episode of Tax Talk with Joel, and in today's episode, I'll be going over my favorite tax strategy. Before I give it away, I think it's important that we understand what tax strategy actually is. You see, a lot of business owners believe that their accountant or tax preparer is saving them money on taxes, but they're not. They're just helping their clients with tax preparation by filling out the tax forms and submitting them to the IRS for compliance. If you want to save money on taxes, you need a tax plan. This is where we review your life, your business, and the regulatory requirements to legally reduce your taxes. Tax planning is done before the end of the year, while tax preparation is done after the end of the year. And once the new year ball drops, there's very little that can be done to help you pay less in taxes. At our firm, we meet with our clients at least once every quarter to review their tax liability, provide them with options on how to reduce their tax liability. Once they're presented with options, they can now make informative decisions to lower their tax liability. This is tax strategy. And there are hundreds of tax strategies that you can implement. Keep in mind that the tax code is over 47,000 pages, so you've got options. But of all the tax strategies, which one is my favorite? Honestly, you should be using all of them. Otherwise, you're overpaying in taxes. But if I had to select one strategy, it would be entity selection. This is my favorite because you can essentially keep your business the same with the exception of a few additional compliance requirements and save tens of thousands of dollars in taxes. For example, let's say that your business makes $350,000 in gross revenue and has $150,000 in business expenses, leaving you with $200,000 in net profit, while your taxes would be completely different under each entity. Let's actually break down how your taxes would apply under each entity so you can see its impact. To make things easy, let's assume you're single, have no dependents, and your business is your only source of income. As a sole proprietorship, you would have to pay both self-employment tax and ordinary income tax. Before we start calculating self-employment tax, we first need to understand what self-employment tax is. Self-employment tax is your tax consisting of Social Security and Medicare for individuals who work for themselves. To calculate it, we will multiply your net profit of $200,000 by 92.35% and then by 15.3%, which totals $28,259. This would be your self-employment tax. Let's now calculate your ordinary income tax. To do that, we would first subtract the QBI deduction. The QBI deduction is a phantom 20% expense given to self-employed individuals and small businesses. To calculate the QBI deduction, we would simply multiply your net profit of $200,000 by 20%, which equals $40,000. As a single taxpayer, you would also qualify for a standard deduction of $13,850. So after subtracting the QBI deduction of $40,000 and the standard deduction of $13,850, your taxable income would be $146,150. Using the 2023 tax brackets, your ordinary income tax would be $28,476. After adding the self-employment tax of $28,259, your total tax would be $56,375. Let's now say you change your business from a sole proprietorship to an S corporation. Well, under an S corporation, one of the requirements is that you pay yourself a reasonable salary. Now, a reasonable salary depends on the job responsibilities of your particular trade. In other words, if you had to hire someone to do your job, what would you pay that individual? We usually recommend that you do a reasonable compensation study to support the salary that you pay yourself in case you ever were to get audited. Now, if you fail to pay yourself a reasonable salary, then the IRS can basically tax all of your draws from your corporation. While one of the benefits of having an S corporation is that your draws can essentially be tax-free because you already paid taxes on the income from your corp. Now, keep in mind that even if you're paying yourself a reasonable salary, draws from an S corporation can still be taxable if it exceeds your tax basis. But for the simplicity of this video, we'll leave that out of the equation. Let's say that your reasonable salary for your particular business ends up being $60,000 a year. Well, you would now have to pay payroll taxes, also known as FICA or Social Security and Medicare tax, on that salary. While the employee's portion of the payroll taxes would be 7.65%, and the employer's portion of payroll taxes would also be 7.65%, which is equal to 15.3%. the same rate as a self-employment tax. So when you multiply $60,000 by 15.3%, because you're both the employer and the employee, you would essentially pay $9,180 in payroll taxes as an S-Corp. Let's now calculate the ordinary income tax for an S-Corp. Remember, your business made $200,000 in net profit. However, your salary of $60,000 is now tax deductible. Also, the employer's portion of payroll taxes, or 7.65%, would also now be tax deductible. Well, when you multiply $60,000 by 7.65%, it equals $4,590 of deductible payroll taxes. So after subtracting the $64,590 deduction, the S-Corp's income is now $135,410. This income of $135,410 would flow to your personal tax return via a form called a K-1. This K-1 is almost like your 1099 from your corporation. Just keep in mind that you will get this K-1 even if you left all of your profits inside of the corporation. So even if you took no draws, you would still have to pay taxes on this $135,410 of S-Corp income. You would also be getting a W-2 of $60,000 from your annual salary since you are now an employee of your S corporation. To find your taxable income, we would add your $60,000 salary and the $135,410 of S Corp income. We would then subtract the 20% QBI deduction from your $135,410, which is $27,082, and your standard deduction of $13,850, making your taxable income $154,478. Using the 2023 tax brackets, your ordinary income tax would be $30,475. But remember, you also had to pay $9,180 in payroll taxes during the course of the year. So your total tax as an S corporation was $39,655. As a sole proprietorship, your total income tax was $56,375. So basically, you would save $16,720 by switching your business from a sole proprietorship to an S corporation. Talk about tax savings. I just found you $16,000 in tax savings using this simple example.
Nice.
Let's now look at your taxes. Had your business been a C corporation? Well, with C corporations, nothing flows to your personal tax return. This is because C corporations pay their own tax. As of 2023, it's actually a flat tax of 21%. This is different from personal tax returns that pay a progressive income tax, meaning the more money you make, the higher tax rate you have to pay. Also, C corporations are subject to double taxation, meaning if you withdraw money from the corporation, it is considered a dividend, and you personally would have to pay taxes on those distributions. To keep things simple, we'll assume that you left all the profits inside the corporation and did not take any draws. Also, C corporations unfortunately are not eligible for the 20% QBI deduction. This is because C corporations are typically, not always, but usually larger corporations. So to calculate the taxes on a C corporation, we would simply multiply the net profit $200,000 by 21%, which would equal $42,000. Now, what would your taxes be if you were an LLC? Well, I actually purposely did not include an LLC in this example because an LLC is not an entity for tax purposes. It is only an entity for legal purposes. Its main purpose is to give you limited liability protection. An LLC can be taxed as either a sole proprietorship, a partnership, an S corporation, or a C corporation. To learn more about LLCs, make sure to watch my other video on the misconceptions of LLCs. So in this example, the S corporation is the winner. Paid a total of $39,655. Second place goes to the C corporation that paid a total of $42,000. And last place goes to the sole proprietorship, which paid a total of $56,375. Now, does that mean you should always do business as an S corporation? No, not always. There are other factors to consider. One of the factors to consider is your filing status and your income. In this example, we use a single taxpayer with only $200,000 of income. However, your situation could be different if you're married, filing as head of household, and are in a different tax bracket. Another factor to consider is the cost to operate an entity. You obviously want to make sure that your tax savings are greater than the cost to operate your new entity. That's it for this video, guys. This is my favorite tax strategy, and I hope I helped you understand why it's so important to do an entity analysis. If you enjoyed today's video, please like, comment, subscribe. And if you want to be notified the next time I upload a new video, make sure to hit the bell as well. Until next time, have a great day.